What's going on, you guys? So in this video today, I'm going to give you a step-by-step guide for complete beginners looking to get started with dividend investing. It's going to be a pretty comprehensive video, and we're going to cover pretty much everything you would need to know as a beginner looking to invest in dividend stocks. Got myself a fresh seltzer. We're going to crack this open, and we're going to get right into it. So first of all, let me tell you what we're going to be covering in this video, because I am not here to waste your time. I want to make sure you're in the right spot and you're going to learn what it is that you're looking for. So we're going to cover what is a dividend stock versus a growth stock, because a lot of people aren't really sure of the differences. We're going to get into that. We're going to talk about how I actually pick dividend stocks and what screening tools I use and kind of how I decide what dividend stocks to put in my portfolio. We're going to talk about investing in dividend stocks versus high yield dividend ETFs and the pros and cons of both of those strategies. We're also going to cover what I view as the best dividend stocks for 2021, as well as the best high yield dividend ETFs. We're going to cover the best brokerages to purchase dividend stocks, and I'll actually show you how I purchase them. And I'm also going to show you my $170,000 dividend stock portfolio, and I'll show you how much I'm actually making from this in passive income on an annual basis. And then we're also going to cover some of the key dividend investing mistakes, just to make sure that you're not going to be making those mistakes yourself. Now, that being said, this video is for those of you out there who are looking to earn passive income, but it's not a get-rich-quick scheme or anything like that. This is long-term growth of your money. You're not going to get rich overnight with dividend stocks, but it's a way that people have been able to earn passive income for hundreds of years. People have been doing dividend stocks, so it's nothing new, nothing fancy, but it's a time-tested way to build your wealth. This video is also for those of you who are looking to buy your first few dividend stocks if you're completely new. It's also for passive investors if you're looking to learn about investing through ETFs. We're going to cover that. And honestly, anyone who's just planning for the future and you don't want to be broke, that's pretty much what this video is. Now, that being said, guys, I do want to ask you for 3 really quick favors here, okay? Number 1, I want you to put your phone on silence, unless you're watching this on your phone. If you're not and you're watching on your computer, look, just commit to sitting here with me for a little bit, and I promise you, I'm going to teach you everything you need to know. I'm not here to sell you a course, I'm not selling anything, and I'm not going to scam you here with bad information. I'm going to teach you everything I know about dividend investing. If you need to, pause the video now, go grab a drink. I got my seltzer sitting right here, so we're already in business, but go grab yourself a seltzer if you need one, get a pad of paper and a pen, and be ready to take some notes here. Lastly, I got a couple of quick disclaimers to make here. I am not a financial advisor. This is not financial advice. You should always do your own research before investing. And also, guys, I've been getting a lot of scam comments down below. It's a massive problem on YouTube. Last week, I actually had somebody who was scammed out of money by a scammer in my comment section. So I'm going to start mentioning this in all of my videos. I apologize to waste your time, but there's a lot of scammers out there, guys, who are basically responding to comments down below, pretending to be me. And I just want you to know that I would never, ever reach out to you directly over the phone or through email asking you to send me money or do anything with Forex or Bitcoin. So if you see these scam comments, please just thumbs them down or comment that it's a scam so other people can see. But just understand that is not me, and I don't want anyone else out there to get scammed. So please do what you can to make other people aware that this is in fact a scam. That being said, guys, let's jump right into it with the first topic here, which is what exactly is a dividend? Well, essentially, when a company becomes profitable, they have a couple of different options that they can follow. The first option is to reinvest your profits back into your business, because ultimately what you're looking to do is grow your business and have it become more valuable, and this is what a lot of companies do. So like Amazon, for example, they make a lot of revenue because they're a massive company, but they actually take a lot of that profit and reinvest it back into the company. So they're not one that's really, paying dividends or sharing profits with investors. Instead, they're reinvesting it, and over time that share price grows instead, and that is what we call a growth stock. But there does come a point for companies where there's no real easy way to reinvest that money for them to become a larger and larger company, because you reach a point where you achieve market saturation and you don't really have a good way to invest that money back into the business. So for example, AT&T is one of these companies that has become so large that they can't really grow much or even grow at all right now because they're so big and well established. They make a lot of money, they make a lot of revenue, and they have high profits, but they can't really grow the company because they've become so large. So instead, what they do is they take those profits and they share some of it with the shareholders in the form of dividend payments. So that is essentially the difference between a company in growth mode versus income mode, but we're going to cover more on that later. So in a nutshell, dividends are a way that large, well-established companies share a portion of their earnings and profits with the shareholders. It also gives investors a reason to stick around, because if you have an investment and you don't have a direct means of making money from it, where the share price is going up in value, if it was just sitting there flat, you would probably sell that stock. But if you're able to consistently earn dividends from it, a lot of people will hang on to that stock because it's a means of deriving income from your investments. Now, let me cover a couple of quick misconceptions here about dividends. First of all, there's no requirement out there that says that companies have to pay dividends. Some companies decide to pay them as a means of keeping shareholders around and rewarding them, but other companies decide to not pay dividends. So, for example, Berkshire Hathaway is Warren Buffett's company where he does his own investments in other companies. It's called a holdings company, and essentially Warren Buffett invests that money in other companies, and he does not pay dividends through Berkshire Hathaway. That is because he believes the best way to return money for investors is to reinvest those profits back into the business, back into other companies, and make money through the share price going up in value, not through paying dividends. So some companies pay dividends, others may never pay dividends. It's ultimately up to that company to decide whether or not they want to actually pay dividends. Now, as far as how often you should expect your dividend payments, well, most companies out there are paying dividends on a quarterly basis. However, you do come across some oddball companies once in a while that pay annual dividends or dividends twice a year, or even there are some monthly dividend paying stocks. So most of the time it's 4 times per year, once per quarter, but you might find some oddballs in there as well. Now, when you earn your dividends, typically they're going to be deposited right into your brokerage account, into your cash balance. However, maybe you're somebody who has an older brokerage account and you might be getting mailed random checks. So if you own a stock like IBM, for example, and you get like a random check in the mail for a couple of dollars, that's probably a dividend check. So it might be getting mailed to you, but in most cases, that dividend is actually being deposited towards the cash balance in your brokerage account. And you basically have 2 choices there. You can reinvest that dividend back into the issuing stock or into your portfolio as a whole, or you can take that dividend and spend it on your expenses. Now, if you're looking to maximize your returns as an investor, the best strategy is to reinvest those dividends, because that means the dividends you earn are able to earn more dividends in the future. But some people actually live off of their dividend income, and they simply take those dividends and they put them in their checking account and they use it to pay for their mortgage and their groceries and different things like that. So think about it this way. Earlier on, when you're starting off, like if you're my age, you take your dividends and you reinvest them in order to get the greatest return on your investment over the long run. And then the goal is, when I'm in my 50s or 60s, is to then live off of that dividend income from your stocks. That way, maybe you have a bunch of shares of Coca-Cola or IBM or something like that. And rather than reinvesting that money back into those stocks to have more shares, you actually just take those cash dividend payments and you use them for your expenses rather than working for your money. That right there, that's what we call the dream here, guys, is to live solely off of dividend income. That way you can choose what you do with your time. So that's kind of the big picture here, guys, of why people invest in dividend stocks. Another thing that you should be aware of is that when you're talking about dividend stocks, a lot of people refer to something called the dividend yield, and that is simply the percentage you're earning as a return based on the entire share price. That sounds a little bit confusing, but let me give you an example here. Let's say you buy a stock that's $100 for one single share, and over the course of 1 year, they pay you $5 in dividends. Well, that means that this particular stock has a 5% dividend yield. And so, assuming that dividend doesn't change, if you buy shares today at $100, you're going to earn a 5% return on that invested money in the form of dividends. Now, as far as yields go, typically looking at dividend stocks, you're going to be in the range of 2 to 5%. However, a lot of people think, oh, let me just go out there and buy 5% plus yielding stocks, but I'm going to tell you later on why that might actually be a mistake. So more on that later. And then the last thing I want to cover in this section here is there's a couple of different dates that you should be aware of as a dividend investor, because you're going to come across these terms and you might just be confused. So let's cover those right now. So the first date that you should be familiar with is called the declaration date. This is when the company board of directors, or the people who make decisions on the behalf of this company, actually approve a dividend. So this is when a company says, yes, we're going to pay a dividend and it's this amount of money. So they announce the amount of dividend per share, and also after they do the dividend declaration here, they also announce the date of record as well as the payment date for that dividend, and let me explain what that means right now. So the payment date is pretty self-explanatory. This is the actual day that you're going to see the dividend credited to your brokerage account, or if you're getting mailed dividend checks, this is the day that that dividend check is probably going to go out in the mail, and you should expect it a couple of days later. But then we have the date of record, and before I explain what that means, I actually have to cover something else called the ex-dividend date. Really confusing stuff here, guys, but I promise you it'll all make sense after I explain it. So the ex-dividend date is simply the cutoff date in order to receive the dividend, because at the end of the day, you can buy and sell stocks on a daily basis, and so you need to have a cutoff date for when you need to be on the books as a shareholder in order to receive that dividend. Because let's say, for example, somebody sold a share of Coca-Cola and then somebody else bought it, it becomes this complicated decision of like, which person gets the dividend? This is why you have to understand these different dates. So the ex-dividend date is simply the date that you have to own the shares by in order to receive the upcoming dividend. So if you buy the stock 1 day before the ex-dividend date, that means you are going to receive that dividend. However, if you buy shares of that stock on the ex-dividend date or after it, you are not going to receive the dividend. It would actually be the person that sold you that stock who would receive that quarterly dividend. So if you're looking around at dividend stocks out there and deciding which ones to buy, take a peek at this ex-dividend date and make sure you're able to buy shares before that date. That way you're eligible to receive that first quarterly dividend. Now, after the ex-dividend date, or the cutoff date to receive the dividends, there's that one other date here called the date of record, which is 1 business day after the ex-dividend date. You really don't even need to be aware of this date here, guys. That is basically just the date that you have to be on record as a shareholder in order to receive that dividend. This might be a little bit confusing here, but there's something called settlement of an investment, and it takes a couple of days for your investment to settle, and you have to be settled in order to receive that dividend. That's why most people just focus on the ex-dividend date. So to be completely honest with you guys, all you have to do is make sure that you buy shares 1 day before the ex-dividend date in order to receive that dividend. So there we go. Confusing topic. Anyways, moving on now to section 2, let's cover the difference between dividend stocks versus growth stocks. So as mentioned earlier, there are some companies out there that are solely in growth mode, which is where they're taking their revenue and they're taking their profits and they're putting it back into the business. They're not doing dividends because they want to reinvest that money and they want to grow as fast as possible. This is what we call a growth stock. And then there's other companies out there like AT&T that don't really have a good way to grow the business and the share price as a result. So instead, they pay a lot of money in dividends in order to keep shareholders around. And this is simply because there's two different ways that you're able to make money when you invest in the stock market. The first one, pretty straightforward, that we already covered, is earning dividends or cash payments from your investments. But there's actually a second way to make money with stocks that we kind of alluded to earlier, and this is when you buy a stock at a given price and sell it for a higher price down the road, and this is simply called asset appreciation. So for example, if you bought a stock at $50 per share and then you sold it for $60 a year later, you have a $10 profit or $10 of capital gains. That stock or that asset appreciated in value while you owned it. And the reason why that stock went up in value is usually due to something involving revenue growth or business growth. Essentially, as the company grows and the company becomes more valuable, the share price goes up as a result. And those are the two ways that you make money with the stock market, either through the share price going up in value or from these dividends. Now, one thing that I like about dividend investing, and there's a lot of reasons why I like it, which is why I do it, is the fact that you don't actually have to sell your shares in order to make money. Because the thing is, if you are just a growth investor and you invest in growth stocks that don't pay dividends, the only way you can make money is asset appreciation, or buying low and selling high. Well, in order to take profits, you actually have to sell some of your shares and recognize those capital gains. And when you do that, you expose yourself to taxes. There are taxes with dividends too, but it's a little bit different. That's kind of above and beyond the scope of this video, but it is something that you should be aware of, is the taxes when it comes to dividends. It's a little bit different than capital appreciation or asset appreciation from stocks. But I like it because when you own dividend stocks, you get paid while you own the stock. You don't have to sell it in order to make money. And the other interesting thing is that it's not one side or the other. It's not like some companies are in 100% growth mode and others are in 100% income mode. Sometimes it's like that, but there's also companies that fall in between. They are still growing and they have means of growing their business and earning more revenue and growing sales and things like that. But there's also companies that fall somewhere in the middle where they have a means of growing the business and making more money, but they also are paying dividends. And this is a category called dividend growth stocks. And this is my favorite type of investment. The dividend yield isn't going to be as high because the company's not paying all of their profits in dividends. They're paying some of the profits in dividends, but they're also reinvesting a lot of money back into the business, meaning the business is growing, and as a result, hopefully, the share price is growing as well. So just for an example's sake, a company like Amazon is 100% in growth mode. They don't pay dividends, they just want to grow the business and they want to dominate, and as a result, the share price has gone up quite a bit. Then we have other stocks like AT&T. They haven't really grown their business that much at all, and as a result, the share price is pretty much flat, but the dividend yield is really high. Then you have companies in the middle, such as Apple, one of my favorite stocks out there. They pay a small dividend, but they also have a lot of growth potential. So you're able to get paid in two different ways. You earn those cash dividends, you can reinvest them, and as that happens, the share price tends to go up in value as well. So that is why dividend growth stocks are my favorite investment, especially being a young person, because I can be a little bit more aggressive. And I like the fact that I can get paid in two different ways. So I could go pure income play here and solely invest in these stocks that are just paying high dividends and they're not really growing, and I could get my portfolio to a 5 or 6% dividend yield. But then there would be very little growth of the underlying share price, and so I would really only be making money from those dividends and not from the growth of my portfolio. So instead, I invest in a lot of these dividend growth stocks. I have a lower yield of around 3%, which I'll show you in a little bit, but it allows me to have asset appreciation as well as dividend payments from my stocks. And in my opinion, that gives me the best of both worlds. So now what I want to cover here is the difference between buying dividend stocks versus investing in high yield dividend ETFs or exchange traded funds. And if that's a foreign term to you guys, don't worry, I'm going to explain that right now. So the strategy that we've discussed so far is picking and choosing individual dividend stocks to invest in. So you sit down at your laptop and you do your research on these companies and you decide, yeah, I want to buy shares of Coca-Cola or AT&T or Apple. And you pick and choose what individual companies that you want to own. But there's actually a different way that people earn dividends in a really easy way, and that is by investing in high-yielding index funds or exchange-traded funds. And instead of investing in just one or two companies, you're actually investing in a whole basket, in some cases of hundreds of different companies that all pay dividends. So basically, instead of putting all of your money into a handful of different stocks and analyzing them, you don't do any analysis. You simply plop your money into a high yield fund, and then you earn dividends from that fund on a quarterly basis. Essentially, every stock within that fund pays dividends, and then collectively, all of those dividends are paid out on a quarterly basis, and overall, that fund has a set dividend yield. And in a little bit, guys, I'm gonna show you my top 3 favorite high yield dividend ETFs, and it's going to make a lot more sense. But essentially what we're talking about is the passive dividend investing strategy, which is investing in funds where it's very hands-off. You don't have to do research and you don't have to really keep up with your investments. You just put it in the fund and you're well diversified. And then there's the active side of it, which is picking and choosing exactly what companies you want to invest in. There's no right way or wrong way to do it, guys. It just depends on your individual strategy. Personally, I like owning individual stocks. It's kind of like fun for me to say, oh, I love Apple and I own shares of Apple. But you may decide it's too much of a headache and you'd rather just put your money into an index fund and not have to do all of that research. I just want you guys to be aware of all the options that you have in front of you. So now what we're gonna do is we're gonna jump into my computer and I'm gonna do a screen share and I'm gonna cover my top 3 favorite dividend funds, and then we're gonna cover as well my favorite dividend stocks. Once again, guys, I just want to mention I'm not a financial advisor, and do your own research on these investments, and I'm certainly not making any recommendations to go out there and buy them or whatever. Like, do your own research and don't like blindly pick my investments just because I picked them. I'm simply showing you what options are available. So let's jump right in. Okay guys, so the very first high yield dividend ETF I want to talk about is the Vanguard High Dividend Yield ETF, trades under the symbol VYM. When it comes to buying index funds or ETFs, you really can't go wrong with Vanguard. They pretty much have some of the best quality products out there with the lowest fees. So when you're looking at these funds, besides the dividend yield, the main thing we want to look at here is the expense ratio, which is how much money you're paying in fees. With Vanguard, it's a minimal fee of 0.06% for this particular fund. That is very low and probably lower than you're going to find anywhere else as far as index funds go. This is pretty much a fund that owns a basket of different stocks. We're going to get into it and I'll show you what companies it owns and some different details about it. So right now, if you're looking to buy shares of VYM, they're going to cost you $91.63 per share, but in a little bit, I'm going to show you how to invest using fractional shares. That way, you don't even really have to care about this share price at all. And more importantly, what is the yield? Well, over the last 30 days, the yield of this fund is 3.25%. So it's certainly not a 5 or 6% dividend yield. That's because you're investing in hundreds of different dividend payers. Some pay higher dividends, some pay lower, and overall, it's 3.25% is your yield at the current share price. Under this section here, you get more information about what is in this fund. And I'm not going to go into this much detail with all of these ETFs, guys, because a lot of them are going to be pretty dang similar. But this one right here, gives you information about what is in this fund. So first of all, this fund holds 414 different dividend-paying stocks, and the average size of the company held here is 118 billion. If you scroll down here, it shows you what sectors you're investing in or areas of the economy. So you can see a lot of the money here is in the financial sector. That is because financials tend to be good dividend-paying stocks. It's a very consistent business. Healthcare is pretty high here as well at about 14%. Consumer staples, another great place for dividends. So it tells you what areas of the economy you're actually investing in. And then one of my favorite parts, it shows you the top 10 largest holdings, which represents 24% of this total fund. And that is Johnson & Johnson, which is a stock that I own. JP Morgan, I don't own that one. Procter & Gamble, I own it. Verizon, I own it. Comcast, I don't have that one. Bank of America, I own it. Pfizer, that's a hot one right now. I don't own Pfizer. Walmart, which I don't own. AT&T, I do not own. And Intel, which is a stock that I currently own. So this shows you kind of, what stocks are within this fund. And then over here on the distributions tab, it's showing you when the dividends are paid. So in this case, there was a dividend paid on most recently September 22nd of 2020 of 70 cents and some change. And then we have the very important ex-dividend date we talked about earlier, which in this case was September 21st. You would need to have bought shares at the latest September 20th in order to receive this dividend. If you bought it on this date, you would not receive the dividend. The person before you who sold it to you would actually be the one receiving it. But there you go, guys. It's a quarterly dividend paying ETF, and it's a pretty quality option. So next up, we have the Schwab US Dividend Equity ETF, which is going to be very similar to that Vanguard one. In fact, it has the same exact expense ratio at just 0.06%, and it trades under the symbol SCHD. And then here we have the yield of this, which is 3.6%, which is a little bit higher than the Vanguard fund that we looked at a second ago. Now, if we open up the portfolio section here, it shows us what stocks are held within this fund from largest to smallest, and we're seeing some different names here. The biggest holding here is Qualcomm. They also have BlackRock, Texas Instruments, ExxonMobil, Coca-Cola, another one from my portfolio. This one also has Pfizer, PepsiCo, 3M, which is a stock that I own, UPS, and IBM, another stock that I own. Just like with Vanguard, it also shows you what sectors are being represented. This one's a little bit heavier in financials, and it goes largest to smallest. And then here we have the most recent distributions, which are on a quarterly basis. And visually, this is a little bit easier to follow with our ex-dividend date, the record date, and the payable date. So again, this fund here just had a dividend announced for December 15th, and you would have had to purchase shares at the latest on December 9th in order to receive that dividend. If you bought it on December 10th, the ex-dividend date, you would not receive that dividend. And then the last fund I want to talk about here is a little bit different. It's also a Vanguard product, but it's actually something called a REIT, or a real estate investment trust, which is another popular investment for dividend investors. And the big difference here is the other funds that we looked at already own stocks, whereas a REIT actually owns real estate, which has a good means for producing income. So essentially, a REIT collectively earns the rents from the properties, and of properties sold, they collect all of that money, and then they pay out a dividend to the shareholders. And it's a pretty decent way to also earn passive dividend income. So I wanted to make you aware of this here. As far as the expense ratio goes, it comes in a little bit higher at 0.12%. But to be honest with you guys, that's still pretty dang low. The current yield for this Vanguard REIT is a little bit higher here at 4.11%. So oftentimes you may find that these REIT ETFs actually have a higher yield than these traditional dividend ETFs that hold stocks. And there's one other thing I want to mention quick here. There's a popular investment out there that trades under the symbol O, which is the Realty Income Corporation. This is one of the most popular investments out there when it comes to REITs. It's an individual company that owns a lot of real estate, and they're actually a monthly dividend payer. So the advantage is here, just like with real estate where you get your rent check every single month. Well, with Realty Income Corp, you actually get your dividend every single month, just like a rent check. I actually don't invest in REITs at all. That's because I invest in real estate in a separate portfolio. I have some physical real estate investments, and I also have some crowd-funded real estate investments. So I already have enough real estate exposure, so I personally don't touch the REITs, but it is an option that you should know is available to you. So now that we've covered some different high dividend ETFs, now we're going to jump into my portfolio and talk about some of my favorite dividend stocks. So here we are inside of my portfolio. I use a commission-free brokerage called M1 Finance. They don't charge any management fees, they don't charge any commissions, and you can get started with as little as $100. I actually have a completely free training that walked you guys through step by step how to get started with M1 Finance and build a dividend portfolio. If you want to check it out, guys, there's a link down below. All you have to do is click it. After you click on that, it's going to bring you to this page right here where you're going to click this button and you're going to drop your name and email, and I will send you right over the link to view that free 30-minute training on how to use M1 Finance. Full transparency here, guys, I am affiliated with M1 Finance, so if you do use my affiliate link, I may earn a small commission in the process, but as you guys can see, this is the actual brokerage where I invest my money. I'm a big fan of M1 Finance for dividend investing, so it's a resource that you may choose to use. And if you want to give back to me for putting this video together, feel free to use my affiliate link, but of course, no pressure whatsoever. Now, in a little bit here, I'm going to show you guys my actual holdings and how much I earn in dividends from this portfolio and my overall return. But for now, let's talk about some of my favorite dividend stocks out there for beginners. So the first one is 3M, which is a stock I have in my portfolio. This is a conglomerate that owns a lot of smaller brands like Post-it, Command Strips. They own all kinds of smaller brands, and collectively, these brands make a lot of money. And that is 3M in a nutshell. It's a large conglomerate that's heavily involved with industrials too, and they currently have a dividend yield of 3.32%. Now, another thing that you should be aware of is, for the most part, I'm investing in something called a Dividend Aristocrat, and this is a highly sought after list of companies that have not only paid dividends consecutively, but they've grown them every single year for 25 years or more. So if you're looking for a good starting place with dividends, I would recommend looking at that list of Dividend Aristocrats. We'll take a peek at it right now just so you guys are aware of some of those companies. So currently there's only 66 companies that have made this list, and these are all companies that have grown their dividend, as I said, for 25 consecutive years or more. Not surprisingly, the very top of our list here is the stock we were just talking about, 3M, which has 57 years of consecutive dividend payment and growth. A pretty awesome record there. So this is a good place to start if you're doing research on dividend stocks, and you're going to recognize a lot of these names when you look at my portfolio because I own a lot of Dividend Aristocrats. So the next stock on my list here, none other than Coca-Cola, a Warren Buffett approved investment. Not much needs to be said here, guys. This has been a great quality investment people have been making for many, many years, buying shares of Coca-Cola. I mean, obviously anything can happen with the stock market. It could go up or it could go down, but Coca-Cola has been pretty solid for me at least, and they currently pay a dividend yield of just above 3%. Next up, we have GPC, which is Genuine Parts Company, one of my favorite stocks that I own. This is actually the parent company of Napa, so if that logo and color scheme looks familiar, that's probably because you've seen the Napa stores. I like this stock for many reasons. I'm not going to get into a ton here. One of the main reasons is because Napa stores tend to do really well during a recession because people hold on to older vehicles longer and they're making repairs to older vehicles. So it's kind of a good recession-proof business, currently with a 3.23% dividend yield. Next up, we have none other than Johnson & Johnson, a diversified medical and pharmaceutical company, a recent addition to my portfolio, currently pays a dividend yield of around 2.6%. Then we have Procter Gamble, which is another recent addition to my portfolio. This falls under the consumer staples. They make things like razors and dish soap and all of these important products that we use in our everyday lives. As a result, another very good recession-proof business, and they currently pay a dividend yield of 2.26%. Next, we have Target. I actually don't own this stock, but it's definitely on my watch list. The dividend yield isn't as high, but if we look at the performance of the stock over the last 5 years, it's done pretty well. So this, again, is why I like dividend growth investing, because you have the potential to make money from the dividend as well as the asset appreciation. I mean, over the last 5 years, this stock went from 70 bucks a share all the way up to somewhere around $170. Next up, we have McDonald's. I don't often eat there, but I do own the stock because I like it. They currently pay a dividend yield of around 2.3%. And then lastly, we have Caterpillar, which is a large construction company. They're also involved in manufacturing. Over the last 5 years, this stock has done pretty dang well too. So you have a good mix here of both asset appreciation as well as dividend income, currently paying a dividend yield of 2.24%. So now let's take a look at my M1 Finance dividend portfolio and, take a peek under the hood here and see what we're looking at in terms of how much money I've made from asset appreciation, or as we're calling it here, market gains versus dividends. So a couple of things I want to say here. First of all, I was able to invest a hefty amount of money earlier this year during the pandemic. As you can see, I ramped up my investments pretty quick here. And by, somewhere around June, I had invested over $75,000. And the thing is, this was a really good time to be investing in the stock market because overall it was down. And then there's been a couple of points in time here where I've ramped up my contributions quite a bit. And overall, I'm thrilled with how this portfolio has performed. In terms of the breakdown, I have made $2,792.60 from dividends, and I've made $21,593.95 from market gain or asset appreciation. This has been a pretty crazy year because of the whole pandemic. Gains have been crazy with the stock market, so you're not going to see this on a typical year with the stock market. Right now, I'm not funneling any more money into this portfolio just because 170 grand, that's a pretty good chunk of change here, and I'm making other investments in real estate. I'm making angel investments in other companies. So right now, I've got enough money in dividend stocks that I'm not adding more money. But what I am doing is every time I earn more dividends, I'm reinvesting that money across this entire portfolio. So with M1 Finance, it's a little bit different than other brokerages because what you're doing is you're creating this pie here, which is your portfolio, and you essentially assign a percentage to each stock. So over here on the right, you can see my target percentages, which for most of these is 6%, and for the bottom two, it's only 5%. And so when you build your portfolio, you say, hey, I want 6% of my money in Bank of America, 6% in Emerson Electric, and so on. So you just set your percentages, and it automates the process of distributing money into these shares. And then, of course, because of the magical invention here of fractional shares, the actual underlying share price doesn't really matter because you're able to buy a fraction of a share of these stocks. So, for example, if we look at Bank of America, you can see that I own 458.1724 shares. Since I'm able to buy fractional shares, I can own a little piece of Bank of America and remain fully invested. So that's why I really like M1 Finance for dividend investors. You have a lot of very useful tools right here at your fingertips. Now, if we jump over to the Activity tab, you can see where I'm earning dividends in this portfolio. I actually earned some dividends recently, and there were 2 market buys today on December 16th in the amount of $143.09. And based on my current percentages, that money went into Johnson & Johnson stock and Procter & Gamble, just because I'm low on these investments right now and I haven't reached my target percentage. But where did that money come from? That came from my dividends, which were from McDonald's and Coca-Cola. So I'm consistently earning dividends in this portfolio as a result of owning these individual stocks, and then that money is automatically reinvested back into the portfolio, allowing me to earn compound interest. And if we look at the holdings tab here, this paints a better picture for the overall performance of this portfolio. This includes both the capital gains or the gains from the market, as well as money earned through dividends. And overall, I have had about a 13.72% return, or exactly 13.72, and I've made about $20,700 from this portfolio. That's if I sold everything right now, which obviously I'm not, but that's the current gains in this portfolio. I'm not going to cover the whole thing here just because I have a whole series where I document my dividend portfolio. I have 17 different stocks here. I'll scroll through it so you guys can pause the video if you want to. But we'll go over my top 5 biggest winners and top 5 biggest losers just for fun. My best investment so far has been none other than Lowe's. I'm up almost 70%. Number 2, Emerson Electric, I'm up about 50%. Number 3, none other than Apple, I'm up about 40%. Number 4, Genuine Parts Company, I'm up 21%. And number 5, Caterpillar, up around 20%. And as far as my losers go, I've honestly done pretty well here. I'm only down in one stock currently, which is Intel, down around 5%. I just added these a couple of days ago, so they haven't really gone anywhere. That's Procter Gamble and Johnson & Johnson. Verizon, I'm only up like 1%. And then Merck & Company, I'm only up about 2%. And then as far as my portfolio goes as a whole, collectively, it's currently earning a dividend yield of 2.687%. Like I said earlier, that's because I mostly own dividend growth stocks. I'm not looking for like a 5% yield because I want a blend of asset appreciation as well as income from dividends. But to calculate how much money this is, I'm going to pull up my calculator and I'll show you what I'm earning in passive income from this portfolio right now in dividends. So we know that my current portfolio value is around $172,000, and now we simply multiply this by my current dividend yield. And the current dividend yield is 2.687%, so we'll do 0.02687. And so in total, right now, I'm earning $4,621.64 per year in dividends, which is automatically being reinvested back into this portfolio. And that's really what gets me excited here, guys, about dividend investing, is the fact that I'm doing nothing. I'm just letting my money sit here in these dividend stocks, and I'm making about $5,000 per year, which is being reinvested back into the portfolio. And every single year, that $5,000 is going to earn more dividends. And then the dividends earn dividends, and you have this magical phenomenon known as compound interest that begins seriously accelerating your wealth. So there you go, guys. That's my portfolio wrap up. Let's get into the rest of the video. All right, guys, so you got a quick peek there at my portfolio. I hope you enjoyed looking in there and kind of seeing my investments. And I also do an ongoing series where I'm building what was a $100,000 dividend stock portfolio. It's grown to be quite larger, but I do regular updates on this portfolio and I kind of share the performance. And so if you want, I will link up to that playlist down below if you want to check out the previous videos if you're curious how I built this portfolio over the last 12 months. And also, guys, if you've made it this far to the video, I'm assuming you've enjoyed it. If you don't mind, just go ahead and drop a like for that almighty YouTube algorithm. It definitely helps to get this video shared with more people. And you can always do your part as well and, share this video with some friends if they're trying to also learn the basics of dividend investing. What I want to cover now are the main dividend investing mistakes that people make early on. Some of them I've made myself. That way you can hopefully avoid these yourself. So the first and biggest, by far, dividend investing mistake is chasing high dividend yields. And this comes back to a big misconception that we addressed early on, which is some people think that dividends are guaranteed, that companies are required to pay them and all the companies out there pay them. That's not true. A dividend is a decision that a company makes to share a portion of profits with shareholders. They can change their mind at any point in time. The board of directors decides what they pay for dividends, and at any point in time they could say, hey, we don't want to pay dividends anymore. Now they know if they do that, that most people who own that stock would sell it and it would go down. And so overall, companies tend to continue paying dividends and they tend to continue growing those dividends over time. But you just need to be aware of this fact that dividends are not guaranteed. They can go up, they can go down, or they can be canceled at any point in time. So what happens is you get these companies that are falling under financial hardship. What happens when a company falls under financial hardship? The stock goes down in value. But what this does is it inflates the dividend yield. So let's say, for example, a stock was trading at $100 per share and it paid $5 per year in dividends. Well, we know from earlier that would be a 5% dividend yield. But then let's say a bunch of bad news comes out about that company, the business isn't doing well, and they're losing a ton of money. So the share price falls to $50 per share. But you know what happens as a result? Now you're looking at that and you're saying, hey, 50 bucks per share, and I'm able to earn $5 per year in dividends. Now, all of a sudden, it has a 10% dividend yield. And so a lot of people see that and they're thinking, wow, guaranteed 10% return? Count me in. But what they don't realize is that there's a reason that yield is so high. It's an unhealthy yield because the company overall is not doing well. So you have to look at the overall bigger picture. If you see a company with a 6, 7, 8, 9, 10% dividend yield, do a little bit of research on the company. How's the business doing? How's revenue? Are there any problems with the industry? Most of the time there is. And so what happens to people is that they buy a stock because they see a 10% dividend yield, and then a couple of months later, the company announces a dividend cut or they eliminate it entirely. And then you're stuck holding this stock that's not paying dividends, and the share price is going down in value, and you're just like, you've been duped at that point. So don't do that, guys. Don't chase high dividend yields. And if you're gonna buy a stock with like a 7 or 8% yield, do a lot of research beforehand because that's a high yield and oftentimes it's a red flag. The next mistake is putting all of your money into a few stocks. This again ties back to the fact that companies can cut or eliminate dividends at any time. So basically, if you only had all of your money in one stock, like let's say, for example, you decided to put your entire portfolio into AT&T. They've been paying and growing dividends for a long time. Hopefully they continue to, but let's say worst case scenario, all of a sudden AT&T, they make some really bad business decisions and they're losing millions of dollars. So what are they going to have to do? They're going to have to cut their dividend. Well, let's say, for example, all of your money is in AT&T stock. Well, if they got rid of that dividend and you were like living off of it, well, all of a sudden there goes your means of income. So especially if you're somebody who is living off of your dividends, you don't want to put all of your money into one stock because that stock could eliminate that dividend and then you're stuck holding this company where you have no means of earning income from it. So that's dividend investing mistake number 2. All right, so the third mistake people make, not doing your research. Do your research, guys. We already covered this, especially if you're buying a high dividend yield stock. Literally do 10 minutes of research on the company, please, just to make sure that the company is doing well and there's nothing like looming on the horizon that could be really bad. For example, back when the global pandemic hit, Ford stock was showing a really high dividend yield of around 10%. I know a bunch of people who bought it thinking they just got the deal of a lifetime, and then Ford ended up getting rid of their dividend, I believe. And so that's something where before you buy Ford stock, do some research and understand what's going on and what's the bigger picture. Another mistake people make is losing patience. Dividend investing is not a get-rich-quick scheme. It's very slow at first, especially when you have a smaller portfolio. But you have to understand, this is like a 20, 30-year investment for some people. Like, I'm probably going to have this dividend portfolio for the next 40 years. So you got to think about the long run and, you know, the potential for your money to grow over time. It's not going to be like super exciting at the beginning. And lastly, the final mistake for young people is not reinvesting your dividends. Unless you're like living off of your dividends or you need that money, you should probably just put it back into your portfolio. That way you can maximize your returns. There's always the chance that, that the price of your shares could go down. But for the most part, if you're diversified, guys, reinvesting those dividends allows you to earn compound interest, and that's going to maximize your returns over the long run. So anyways, guys, that is going to wrap up this video. I hope you enjoyed it. It was a marathon video, but honestly, I really enjoy making these tutorials. I know my content's kind of been all over the map lately with YouTube, but I think this is where I'm going to stay here. I like making these very helpful videos that kind of give you all the information you need. No fluff, no courses, and it's not a pitch fest. I'm really just here to provide value at the end of the day, and I hope it came across that way. If you did get value from this video, like I said, a thumbs up would be great. And leave me a comment down below with your favorite dividend stock, or if you're currently investing, let me know how that's going, and I'd love to get the conversation started down there. Like I said, I use M1 Finance for my dividend portfolio. If you choose to as well, I have that free training down below that shows you step by step how I was able to create this dividend portfolio. And full transparency here, guys, I am affiliated with M1 Finance. So if you use my link, I may earn a small commission in the process. But thanks so much for watching, guys. Subscribe and hit that bell for future notifications, and I hope to see you in the next one.